Today we are looking at three significantly undervalued stocks from this list that Morningstar has just dropped yesterday. We're going to analyze three of the most discounted companies that are trading at around a 50% or more discount according to their list and analysis. We're going to do our own performance, our own analysis, run it through our valuation model to get to what we believe is the intrinsic value. We're going to run through each one, seeing what our intrinsic value is based on our own estimates and judgments, what is our acceptable buy price given our margin of safety, and as always, we will run them through our valuation process. So the first company we're looking at today is Comcast Corporation. Now last year, 2013, they had a very strong year, up 23%. We can see it is in the mid to upper end of the 52-week range, and we can see it currently offers a yield of around 2.66%. Now, if you've been holding this company over the last 10 years, as you can see, you'd be up around 63% without including dividends. Now, it's not the greatest, and we also can see here the all-time high summer 2021 over $60. So let's take a look at the dividend safety, some important financial metrics. We can see dividend safety score 89. It is very safe. Market cap 176 billion, so we're talking about a mega cap company. Now, in terms of the recessionary metrics for those that see a recession this year, they increased during the last recession, plus 3.5% recession sales. Remember, above the average growth of the recession in 07-09, which was around negative 12% for the S&P. And we see a near recession return, negative 52% versus the S&P's negative 55%. Now, when we take a look at the dividend growth, well, great to see last year 7.4%, above that 4% we advocate on the channel, which also means we are expecting an increase this month from Comcast, which will be great to see, especially as the last 5 years on average they've increased it double digits. The last 10 years, again, double digits at 13%. Very, very good to see as dividend growth investors. They have also been increasing those dividends for the last 14 years. Now, dividend yield theory, for those that are new, states that the company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation, 2.66 current yield versus 2.16 5-year average. But as always, we never look at any of these models in isolation and will draw conclusions towards the end. Forward PE then, as we can see, 10.6 below that 5-year average of 13.7, another sign of undervaluation, and we see it is significantly lower than the communications sector PE of 17.7. Now, as always, we focus on free cash flow payout earnings. For those that are new, we ignore it is susceptible to manipulation by management through accounting. My personal preference, one of my metrics, below 60% on this payout, gives me faith that management have that ability to offer those double-digit increases we love to see. Now, over the last 10 years, in fact, it's been below 40%, 2022, 39%, 2023 expected more of the same. So again, I am confident that this month we should see a very nice dividend increase well above that 4% we advocate on the channel. Free cash flow per share more than doubled over the last 10 years, 125 in 2013, 280 in 2022. So it is moving in the right direction. 2023 expected to go higher. We do see some inconsistencies where it has dropped, but it has always rebounded back up, which is very nice to see. Sales growth, nearly double digits every single year. We do look for steady, moderate growth, so 3 to 7% as a minimum. But a few things to point out. 2022, it did keep up in line with inflation, which isn't bad. It is the minimum we look for. But 2023, they are expecting their growth to be flat. So something just to keep an eye on when looking at the forward guidance that management will give in their annual report and quarterly earnings. Total sales then numerically, they have essentially doubled their top line, 65 billion in 2013, 121 billion in 2022. Again, very positive to see. And on top of that, they do share buybacks, returning excess cash to investor pockets, 5.33 billion shares in 2013, 4.43 in 2022. So that is a positive sign to see this alongside those dividend growth increases. Very positive in my opinion. ROIC then, try and aim for a minimum of 10% in companies that you invest in or that you look through a stock screener. It should give you faith, or gives me faith anyway, that management are able to effectively allocate their capital. They have been pretty consistent other than that COVID year where it did drop to around 7%. Last year at 10% with 23 expected 11% is a positive sign, especially when you see consistency. It is something I do quite like to see as an investor. Operating margin, free cash flow margin, both above the minimums we look for, 12% and 5% respectively, and 2023 is expected to be pretty much in line with the prior year, so that is positive. Now finally, the net debt to EBITDA, earnings before interest, tax, depreciation, amortization, shows us two things: balance sheet strength as well as dividend safety. We can see in 2022 at 2.71, which tells us the number of years it would take the company to pay off all of their debt net of cash on hand. Below 3, positive. 2023 expected to come down even lower to 2.47, so there is no real worries with that dividend safety as well as the company's balance sheet so far based on the information we have. As always, we'll run it through the valuation model. For those that are new, we typically on the channel run through Graham's valuation, multiples, the dividend discount and the DCF model before arriving to the intrinsic value. For today, we'll jump straight into this output tab. We get the intrinsic value. As we can see here, we have the 4 different valuations and the average comes to the intrinsic value of $56.47. Now the current price is sitting around $43.67 and we typically start off with a 10% margin of safety if we believe it has a wide moat, strong financial metrics and good forward-looking data. We can see it's a buy up to $51. If we move it to 15%, up to $48, up to 20%, $45, and at 25%, it's around $8 shy of the current trading price. So we see around 25% margin of safety to Comcast at the current trading value. In terms of Wall Street and what they see, well, they see around a 15% upside over the next 12 months. So in conclusion, for Comcast, we see around 25% margin of safety based on our estimates and judgments, with around 15% upside per Wall Street and their forecasting. We then move on to the second stock, which is Hasbro. Now this hasn't had the greatest 2013, down nearly 20%, trading at the 52-week low, the mid to lower end of that range. And we can see it does have a high yield of 5.61%. Now if you've been holding this over the last 10 years, you can see it's down around 4%. We can also see that it is an all-time high of well more than double the current trading price at $124. And this is one of these stocks that Morningstar does believe to be incredibly undervalued, trading with a very significant margin of safety. So let's jump straight in. Dividend safety score 50, it is borderline safe. Market cap $7 billion, so we're talking about a mid-cap company. Now those recessionary metrics, well, they maintained the dividend during the last recession. Negative 4%, so above average growth. And we do see the recession return is in fact significantly outperforming the S&P with a negative 24% return. Dividend growth, well, they haven't increased it since February 2022. Last 5 years on average at 4%, so at least keeping up in line with inflation. Last 20 years at 17% on average, so that is something we do want to see the company bring back, those nice double-digit increases, and we can see they've only been increasing those dividends for the last year. Now, in terms of dividend yield theory, we can see some significant undervaluation. Current yield 5.61 versus the 5-year average of 3.16, and the forward PE showing another sign of undervaluation, sitting below that 5-year average. And if you compare it to the consumer discretionary sector PE, it is slightly higher, with the consumer discretionary sitting at 14.6. Now, in terms of free cash flow payout, up until 2021, it looked pretty decent, around 60% or lower for the majority of the last 10 years. 2022, and this is why we do say we focus on the free cash flow, because if you were looking at the earnings, you would be happy, 63%. What this is showing in 2022, they paid out 195% more in dividends than they generated in free cash flow. So that is a red flag indicator, and we can see why they haven't increased that dividend. But on the more positive side, 2023, 2024, it is expected to come down, so that is a positive sign, but something again just to keep an eye on. Free cash flow per share, well, 222 in 2013, 143 in 2022. It has decreased over the last 10 years, but we can see it has been increasing before falling, so it is important just to understand whether or not this is something that management forecast over the next 2 to 3 years, picking back up to those levels that we saw around $4 to $6. 2024 is expected to pick back up to $3.74. Now, when we look at sales growth, a bit of a mixed bag. We see 2020, 2021 double-digit increases. Before then, pretty much around that 3 to 7% that we look for. Although do note, 2022 and 2023, we are expecting to see negative 13% growth to the top line. So how does that look numerically? Well, $4 billion in 2013, 5.86 in 2022. Now, we love share buybacks, but what we don't like to see is share issuances, diluting your position as a shareholder. They've done both across the last 10 years. The net position, however, would be a dilution. 132 million shares outstanding in 2013, 139 in 2022. Now, when we look at the ROIC, it's positive to see they did have a very strong run from 2013 to 2017. It has come down, but still, even over the last 2 years and expected 2023, it is sitting at 12%. It is something that I personally can still get behind. Free cash flow margin, operating margin. Well, the operating margin pretty much hovering around that 12%, so that is positive to see. Free cash flow margin, pretty decent overall. The only thing to note is in 2022, it did drop to 3%, although it is expected to pop back up to 4% in 2023. Finally, net debt to EBITDA, we can see 2022, it was below 3 at 2.87, although 2023, it is expected to go higher. So something just to keep an eye on, especially with that dividend, which is above 5%, and the fact that their free cash flow payout over the last year was above 100%. So again, these are things just to consider. Now, when we jump into the valuation model, what we can see here is the intrinsic value is essentially the average of these models. And as always, if you enjoy the content and values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. So current price at $49.90 with an intrinsic value of $60. At 10%, we see a buy up to $54. At 15%, we see a buy up to $51. And at 20%, we see a buy around $48. So it is hovering between a 15 to 20% margin of safety. Now, in terms of Wall Street, what do they forecast? Well, they see growth even further than the intrinsic value that we've calculated. So they see a very strong 30% upside to the current trading value. So in conclusion, for Hasbro, we see around 15 to 20% margin of safety based on our estimates and judgments, with Wall Street expecting around 30% upside over the next 12 months. So they do deem this to be a fairly strong buy. Now moving on to the third company we're analyzing, it is ALB, Albemarle Corporation. Now last year they had a horrific year, down 32%. They are trading pretty much towards those 52-week lows with a yield of just over 1%. If you've been holding this over the last 10 years, well, surprisingly, you would still be up over 128%. Do bear in mind it doesn't include those dividends, and we can see it did hit its all-time high at the back end of 2022 at $325, more than double the current trading price. So let's take a look straight away. Dividend safety score, very safe, sitting at 99, 17 billion market cap. It is a large cap company. Now when we look at those dividend recessionary metrics, it increased the dividend during the last recession, below average growth of negative 23%, and underperformed the S&P with a negative 63% return. Dividend growth, while not the greatest last year, 1.3%, so we are expecting another increase next month. 4% on average over the last 5 years, 9% over the last 20 years, so a mixed bag of growth metrics there. And when we do take a look, one thing to note is they are a dividend aristocrat. They have increased those dividends over the last 25 years or more. Now, when we look at dividend yield theory, we can see that sign of undervaluation. Current yield 1.09 versus that 5-year average of 0.97. Although do note the forward P is sitting higher at 16.4 versus that 5-year average of 14.1. Now, when we take a look at the sector P, we can see it is slightly lower at 16.4 versus the materials of 18.4. So taking a look at the free cash flow payout, we can see some inconsistencies here. We can see it quite low in negative, in fact, for 2017 to 2022. And we will discuss that, or in fact, we can point that out when we look at the free cash flow per share. So what we can see here is that over the last 10 years, it has been very inconsistent. 2022, although at 29%, is positive to see. 2023 expected 40%, again, is another positive. But as we can see when we take a look at that free cash flow per share, they have had significant number of years of negative free cash flow. 2013, 331, 2022, 552. It has increased over the last 10 years, but it is important to note the inconsistencies where they have struggled with that free cash flow over the 5 years of the last 10. Now, when we take a look at the sales growth, what we can see here, again, very inconsistent. We do see some strong years of double-digit growth, especially in 2022, and expected in 2023 of 77%. And when we look at it numerically, they have grown quite significantly over the last 10 years. 2.39 billion in 2013, 732 in 2022, but do note the inconsistencies where it was only a few years while we see some tremendous growth that did really propel those top line figures, just under 10 billion expected in 2023. Shares outstanding, pretty simple to see here. They have diluted your position as a shareholder over the last 10 years. 2013, 84.3 million outstanding. 2022, 118. Now, when we take a look at the ROIC, it is fairly positive. You do see for the majority of the years above 10%. 2022 at 21, 2023 expected 16. Some years, though, it did drop, but overall, it is fairly positive, although do note the inconsistencies. Just something to be aware of. Some investors may not like the inconsistencies. Some may prefer to see more consistent ROIC figures. Operating margin, very nice to see. It is above that minimum 12% consistently. Although, again, inconsistencies here. Some years it's pretty much straddling on that line, as we see in 2014. Some years pretty high, it's like 2022. Free cash flow margin, then, we do see, due to the fact that it was negative free cash flow per share, quite a number of years of negative, which isn't great. It isn't what you want to see. But on the more positive side, 2022 at 9%, with 2023 coming in line at 5%. And then finally, the net debt to EBITDA, positive news here, 2022 0.57, well below that 3 maximum. 2023 expected more of the same, which shows us why it has that very safe dividend score, and it gives us faith that that balance sheet is looking very strong for the future for ALB. Now, in terms of the valuation model, and as always, if you do want to click on that pinned comment below, you can grab a copy of this model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio or even those on your watch list. So the current price sitting around $146. If we start off with that 10% margin of safety, we get a buy up to $190. And then when we take a look at 15%, we can see a buy up to $180. And then when we extend that 15% to 20%, we see a buy up to 169. If we go to 25%, 158, and we can keep going until we get roughly near the acceptable buy price. So we see for ALB around a 30% margin of safety. Now, when we take a look at what Wall Street forecasts, we can see around 40%, in fact, more than 40% upside, pretty much in line with our intrinsic value. So in conclusion, for ALB, we see around a 30% margin of safety with around 40% or more upside per Wall Street targets. As always, though, do let me know your thoughts in the comments below. Are you looking to add any of these significantly undervalued with a lot of upside stocks, or are there any reasons why you may want to avoid them? As always, if you've enjoyed the content, smash that like button, hit the subscribe and bell button. Let me know your thoughts below. If you enjoy this type of content, let me know. If there's any other type of content you want me to focus on, also drop it below in the comments. Finally, don't forget to click on that pinned comment below where you can grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies, whether it's your own portfolio or on your watch list. As always, have a great day and catch you all in the next episode. Take care.